There's a lot going on in the world. The war in Ukraine, gas prices are on the rise, inflation is on the rise, millions of people are quitting their jobs, there's millions of open jobs out there, and the stock market is currently declining, which leads to a lot of news and headlines talking about corrections, bear markets, and recessions. And today we're going to talk about what each of those three things are: corrections, bear markets, and recessions, what they mean to you and your money, and then stick around to the end because we're going to talk about some opportunities that we see.
Welcome to the Your Life, Your Money podcast with Scott Sierens, teaching you how to thrive in life, wealth, and retirement.
Welcome to the Your Life, Your Money podcast. I'm your host, Scott Sierens, and in today's episode, we're going to be talking about some terms that you might be seeing in the headlines or seeing in the news. We're going to talk about corrections, bear markets, and recessions. There's a lot of horrific things happening now in Ukraine. On top of that, we're seeing that gas prices are on the rise, inflation's on the rise. Maybe you've seen in the news, but also that the stock market has been declining. And a lot of this can lead to headlines trying to grab your attention. Some headlines look worse than others, and in these headlines you might see those three terms: correction. You might see the term that, we're approaching a bear market, or you might see in the headlines people talking about recessions. And a lot of this can sometimes lead to worry. It can sometimes lead to uncertainty. And I find what helps is gaining knowledge in regards to these different terms, so that way you fully understand them. So today we're going to talk about what these terms actually mean, and then what does that mean to you and to your money. So there's going to be a lot of information that we're going to cover in today's episode. There's going to be different statistics that I'm going to reference, and all of the links for all of the different references that we're going to talk about are going to be in the show notes. So go to lifemoneyshow.com. Again, that's lifemoneyshow.com to look up episode 46, and you'll have links to all of the different references that we're going to go over. Also, at lifemoneyshow.com, there's other podcasts, blogs, articles, videos to help you thrive in life, wealth, and retirement. So here we go. Let's start. And I'm just going to work through these. We're going to start with correction, go to bear markets, go to recessions, and then stick around to the end because I'm going to talk about some opportunities that you may wish to think about. Okay, here we go. First off, what is a correction? Straight from Investopedia, I think it's important that we just talk about the definition here. In investing, a correction is usually defined as a decline of 10% or more in the price of a security from its most recent peak. Corrections can happen to individual assets, like a stock or bond, or to an index measuring a group of assets. An asset, index, or market may fall into a correction either briefly or for sustained periods, days, weeks, months, or even longer. However, the average market correction is short-lived and lasts anywhere between 3 and 4 months. So, to recap there, what is a correction? A correction is when there is a drop in value of 10% or more from the most recent peak. So they're not measuring what just happened in the month of February or what happened in the month of January. They're saying, when did the index peak or the value of that stock? And a lot of people use the S&P 500. Now it's important to know that you can't just invest in the S&P 500. It's measuring the 500 largest stocks in the United States, but you can invest in index funds that are trying to replicate the S&P 500. So let's just use that for an example. So what they're looking at is, okay, when did the S&P 500 hit its peak value? Now that could have been last year, and then when the S&P 500 hits a correction is from when it was at its peak value to wherever it's at today, did it have a drop of 10% or more? And if it did, then you'll hear sometimes they'll say, well, the S&P 500 has entered correction territory. Now, I think it's important to understand how often does this happen, how long does it last, and what are the causes. So let's talk about some of the causes, right? Because, hey, now we're already talking about declines in the stock market, declines in the index, the value of the index. And so I think that's maybe already going through your mind of like, wait a second, does that mean the value of my money is going down? And we're going to talk about that in a little bit. But I think it's important to understand, first off, what are the causes? And is this something that happens often? Something that doesn't happen often? Is this something that we've been through before or not? First off, the causes. Causes of a correction: slowing economy, change in investor emotion, fear based on new news. Things that happened out in the world can sometimes create fear, which creates sell-off. The sell-off creates a decline in the value, which can create a correction. Or it could be just from any other economic or other events, meaning inflation or oil supply shocks. All of these things can potentially lead to a correction. Now, might be thinking, but gosh, a 10% drop from the high? Like, that sounds like, holy cow, I don't want to hear about that happening. What you might not recognize is that this actually happens a lot. Investopedia says, from a different article here from Ben Carlson, A Wealth of Common Sense. Again, we'll link to it in the show notes. Since 1950, we've experienced a correction on average every 2 years. So while our perspective might be just in this moment, right, this moment of seeing the value of the stock market decline, that's a short-term perspective. And if we enlarge our perspective and we think about this, and according to the article here, these corrections, these 10% drops in value happen on average every 2 years. But I want you to think about one thing, and I'm going to remind you of this as we continue to go through today's podcast. Would you say that the value of the stock market is higher today than where it was 5 years ago? Is it higher today than where it was 10 years ago? Is it higher today than where it was 15 years ago? And we're recording this in March of 2022, and the answer to all of those questions is yes. The stock market's higher today than it was 5 years ago, 10 years ago, 15 years ago. So even though we've gone through these corrections, we've seen that the stock market in history has rebounded. Now, must say this at some point in time during this podcast, right? Past performance is never indicative of future results. However, history has shown us that the stock market has rebounded from these different corrections. Another thing to understand, because I know that sometimes when we're going through these stock market corrections, the days, right? The days can sometimes seem like years. But actually, on average, the average duration of a stock market correction, that fall, right, of from peak to trough of 10%, and then how long does it stay corrected? On average, the duration is 4 months. So I just want to put this in perspective because I know it feels like, oh gosh, it's happening. Well, one thing is that we've been through it before, but the other thing I want to talk about is prepare your mind. If you think, and I work with a lot of folks that are entering into retirement or preparing for retirement, if you think about a retirement that might last 30 years or longer, well, if we take that 30 years and divide it by that 2-year average, you may see another 15 market corrections throughout your retirement. If you're somebody who's got a 50-year investing horizon in front of you, you might see another 25 market corrections, maybe more, maybe less. But I just want you to prepare your mind. What we're seeing, right, with these declines in the market have happened before, and it's not, well, if it will happen again. It's more like when it will happen again. So I just want to, again, put everything into perspective when it comes to corrections. Yes, we've seen them. Average duration, according to Investopedia, 4 months, and we've seen them about every 2 years. And that correction means the decline from the peak to the trough of 10% in regards to the overall value. So, okay, that's what a correction is. And again, what this means to you and to your money, we're going to get to that here in a bit. Next item. What is a bear market? Just want to go through all of these definitions first. What is a bear market? You might be seeing this in the news. Sometimes the headlines will say a certain index like the S&P 500 or the Dow is approaching a bear market. What is a bear market? A bear market is when a market experiences prolonged price declines. Again, all this straight from Investopedia here. It typically describes a condition in which security prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. Bear markets are often associated with declines in an overall market or index like the S&P 500, but individual securities or commodities can also be considered to be in a bear market if they experience a decline of 20% or more over a sustained period of time, typically 2 months or more. Bear markets also may accompany general economic downturns, such as a recession. Bear markets may be contrasted with upward trending bull markets, and we'll talk about that a little bit at the end. So, bear markets. There's the definition. Again, top, right? When the market peaked, again, let's use the S&P 500, to if it's in a decline, from that peak to wherever it declines to, if that hits 20%, then that would mean, and again, it's saying over a sustained period of time, typically 2 months, then that would mean that market, that specific market or index, or as they had mentioned, you could have an individual stock, so like one individual company that's in a bear market. 20% from top to bottom. Now let's talk about a few things when it comes to bear markets. First off, what are the causes of a bear market? The causes could be a weak or slowing economy, geopolitical events like wars, pandemics, or maybe a paradigm shift in an economy, shifting like from, brick and mortar to everything goes online. So all different, potential causes of bear markets. Have we been here before? Yes. Some recent examples of bear markets would be the global financial crisis of 2007 through 2009, and then the COVID pandemic. Now, according to an article here by Hartford Funds, since 1928, we've seen 26 bear markets. That would mean a bear market approximately every 3.6 years. And the average length of the bear market, right? Like how long did the bear market stay? Did the value, right, stay at that drop of 20%? The average length of the bear market was 289 of bear markets is 289 days or 9.6 months. Now, and I thought this was really interesting and something that we should all be aware of and thinking as we're going through these current economic times. After World War II, so since World War II, bear markets have actually been less frequent. So after 1945, we've only experienced 14 bear markets, which means that we typically see a bear market, again, top to bottom, 20%, every 5.4 years. So we've seen it before, and will we see it again? I want to just prep your mind for the future. If you're looking at a 30-year retirement and we divide that by an average of 5 years, you could potentially see 6 more bear markets throughout your retirement, right? And does it mean it's going to be 6? Could be more, could be less. Some, every one's a little bit different. But again, and I want to go back through the same process, the mental process that we did with the market corrections. Is the market at a higher value today than it was 5 years ago, than it was 10 years ago, than it was 20 years ago? And the answer to all of those questions is yes, the market's at a higher value today than it was in the past. So history has shown us that the market has recovered from each of these different bear markets. And I'm guessing during each of these times, right, the COVID pandemic, the bear market of 2007 through 2009, each of those times, we as humans, right, as we're going through that experience, we're going, oh, but this time is different. This time is different. So even right now, I've sat down with some different folks and we've having our discussions and they're saying, I think this time is different. We've said that a lot of times before, and each time, and I think this is just, the strength of our U.S. economy is that each time we, continue to remain strong and prevail through these events. And in my opinion, we'll continue to do that in the future as well. Now, one thing that you might see out there in the headlines is that the NASDAQ hit a bear market this month. So the NASDAQ, which is an index, again, you can't invest directly into the NASDAQ, but you can invest into index funds that replicate it. The NASDAQ actually hit a bear market this month. Does that mean you lost 20% in regards to what you're invested in? Well, that all depends. And again, I'm going to get to that in a second of what all of this means to you. So that's the definition out of a bear market. That's how often we see it. That's how long they can potentially last. And have we been there before? Yes. Could we potentially see it again in the future? My guess would be yes as well. All right, next, let's talk about recessions. What is a recession? Well, a recession is an macroeconomic term that refers to a significant decline in general economic activity in a designated region. It had been typically recognized as 2 consecutive quarters of economic decline as reflected by the GDP, gross domestic product, in conjunction with monthly indicators such as a rise in unemployment. However, the National Bureau of Economic Research, NBER, which officially declares recessions, says the 2 consecutive quarters of decline in real GDP are not how it is defined anymore. The NBER defines a recession as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. All of that directly from Investopedia. I'll put a link in the show notes. You can go lifemoneyshow.com to see all of the different definitions that I'm talking about here today. When it comes to recessions, first off, I'm not sure if you were aware of this. This was something I knew about recessions, knew kind of the overall definitions of recessions, but I thought this was really interesting and unique. It's the National Bureau of Economic Research who actually declares a recession. Thought that was interesting that there's actually somebody out there, right? There's a person, a National Bureau of Research, a team that declares when we are in recession. Now, when it comes to recessions, right? I know it's tough to say they're normal, but they are normal. But I get it, right? Even though they are normal, they're a very unpleasant part of the business cycle and can cause a lot of worry, can cause a lot of uncertainty. We see slow growth in production, and sometimes we see elevated unemployment. Now, have we been here before? We sure have. According to Investopedia, we've had 33 recessions since 1854. Taking a look from a more, I'll call it recent type period, since 1980, we've experienced 4 recessions. Post-World War II, so, well, and just like the other ones, have we been here before? Yes, we have. How long do they last? Well, let's just look at a couple examples, because I think sometimes when we hear recessions, again, the days can start to feel like years. And we have to think about perspective, and we have to look at some other examples to remember that this too, in my opinion, this too shall pass. So post-World War II, the longest recession was that of 2007 through 2009, right? And that was actually, I know I just kind of showed or talked about a 2-year time frame there, but that recession was actually 18 months long. So could be 18 months, could be longer. However, we also experienced a recession when the COVID pandemic came about. And that one was as short as 2 months, in which we were then through that recession. So if we are to enter into a recession, how long could it last? Well, nobody knows the answer to that question. But in my opinion, as I had mentioned, right, since 1980, we've been through 4 recessions, and since 1854, we've seen 33 recessions. In my opinion, this too shall pass. So hopefully that helps giving an overview of all of those different items. So as you see those terms now in the headlines, you know exactly what they mean. But now let's start to relate it to you. What does this mean to you and what does this mean to your money? Because I get it. I understand. Sometimes when we see these headlines, it can lead to worry. It can lead to uncertainty in regards to our savings, our investments, our overall plans. So what does this mean to you? First off, one of the things that I think it's important to understand is you see these headlines. So now I've talked about a correction, right, as a drop from peak to trough of 10%, a bear market, peak to trough of 20%. So if you hear that the S&P 500 is in correction, right? Does that mean that you and your investments are down 10%? Or as I'd mentioned, the NASDAQ, right, is in a bear market. Does that mean that you and your investments are down 20%? Well, that really depends. It depends on you and it depends on your holdings. So if everything that you own is in one index that's trying to replicate the S&P 500 and the S&P 500 is down 10% or 12%, then you may potentially be down 10% or 12%. If you're in one index replicating the NASDAQ and it's down 20% or 22%, then you may be down somewhere similar to that, 20 or 22%, depending on how much the index that you're invested in replicates that overall NASDAQ index. You could be a person who just put all of your money in one stock and you might be doing just fine, or you could be down potentially way worse than 20%. It all depends on your holdings. So when you see these headlines, that doesn't necessarily mean that's what your investment portfolio is doing. For example, with our clients, we take a very diversified approach. In their portfolios, we have, portions of their portfolio in large cap index funds, mid cap index funds, small cap index funds. So meaning large businesses all the way to small businesses, international index funds, emerging markets index funds, as well as bond funds, depending on that person's age and timeline. And so all of those different funds are reacting differently to market conditions. So it's the mixture, and this is the importance of having a diversified approach. It's the mixture now of all of those funds and what their value is doing based on economic times of where you might actually be. So to recap on that point really quick, just because you see it in the headlines that the market, right, sometimes when people say the market, they're referring to the Dow or the S&P 500 or the NASDAQ, right? Because if they're saying that the market has corrected or the market's in a bear market, that does not necessarily mean that you and your holdings have fallen that 10% or that 20%. It all depends, again, on what's in your overall portfolio. This is also a good reason for our folks that are approaching retirement or in retirement that we have that war chest. I've always nicknamed it the war chest, but you can look at that as bond funds in their portfolio. Having that war chest really provides balance as you see equities, stocks dropping in value. Typically the war chest holds its value. Now it can go up and down a little bit as well, but it typically holds its value and is less risky than stocks. So providing some of that in an overall portfolio would again mean that your total portfolio may not be dropping as much as what you're seeing in the news and headlines. So all depends on your specific portfolio. All right, let's talk about some other ways and what this means to you. Now, if your portfolio has dropped, right, let's just say that your overall portfolio or the stock market has hit a correction. Does that mean things are going to continue to drop and that we're automatically also going to go into a bear market? Not necessarily. If you look through historic times, not every correction leads to a bear market. So it doesn't mean that portfolio values will continue to decline. So the next question that might be on your mind, will your values decline further? Well, potentially yes, potentially no. And the thing is we don't know the answer to that question. I think those examples that I gave earlier when it came to past bear markets, right? The 2008 crash, that bear market lasted 18 months. COVID, the bear market lasted 2 months, which I think then should help us really think about things in regards to maybe the next question that's potentially on your mind when it comes to your money. Hey, the stock market, I see that it's declining. Should I sell? Well, first off, this is just a decline in value. It's not actually a loss on your books until you sell. So in my opinion and how we manage with our clients, or the opinion and recommendations that I give to my clients is no. If you've got a plan in place, you have a strategy in place, then you should not sell. And again, it goes back to those examples I give. If you were to sell, how do you know when to get back in? Because that COVID example, 2 months long, how would we have ever known to get right back in? The 2008 crash, 18 months long. And if you go through history, all of these have different lengths and different durations, all based on what's happening in the world and things that nobody has the ability to predict. And I think this is what then leads to the last point when it comes to your money here, is the importance of having a plan and having a strategy. This is where that war chest comes in. So as we're working with clients, as we're developing a plan, as we're talking about their overall plan, you'll continue to hear me have conversations to say, do you have any major expenses coming up in the next 5 years? What does your overall income needs look like over the next 5 years? The reason why we're talking about that is because, like we're seeing now, the stock market can not only go up, but it can go down. We want to make sure that we're carving off portions that you might need to be prepared for times like this when the stock market goes down. So with our clients, we're carving off that war chest. We're having those discussions about 5-year needs, about upcoming income needs, and carving that off into the war chest so that way we've got places to go to grab income, to grab those needs while the stock market goes through its volatility and, in my opinion, will rebound over time. So having a strategy and sticking to that plan is what's really important. Now last, I wanted to talk about some opportunities, right? I realize some of this can kind of feel down, talking about declines in stock values and declines in our potential investment values, but let's talk about some opportunity here. So the first opportunity that I wanted to talk about is when the stock market goes down like this, it's actually a buying opportunity. Let me just walk you through an example. I know what you're thinking right now. Wait a second. It's really tough to think about as you watch your portfolio value go through a potential decline. It's really tough to think about how this is a buying opportunity. So let's just take ourselves out of the stock market for a second, and I want to walk you through an example here. Let's just say that you have 2 stores in front of you, and those 2 stores are selling the exact same goods or services. Exactly the same. No difference. Same quality, same everything. Store A, the price on those goods and services, Store A continues to drop the price on those goods and services, right? They're given some great sales on those goods and services. Store B is raising the price on all of those goods and services. Which store would you go into to buy the goods and services? I think it's pretty obvious, right? If everything is exactly the same value for that product, right? Well, we're going to go into store A where the product is on sale. And this is exactly what's happening in the stock market. You can look at the stock market as being store A right now. It's on sale. They're giving a reduction in the price of those goods and services. And so it becomes a very good buying opportunity. If you feel that the value of the stock market will be higher in the future than it is today, well, again, you're looking at store A, the prices are dropping. It's a good buying opportunity while things are on sale before the prices go back up. So there's one opportunity that I see out there. Now, you might be thinking, well, that's great, Scott, but what if I'm retired and I'm no longer have employment income coming in to go buy those goods and services? I'm relying on my portfolio. Great question. This is actually a good time then to look at rebalancing your portfolio, meaning portion of your portfolio has gone lower, and then a portion of your portfolio maybe has become a little bit more, or potentially has gone higher, or has remained the same. And so it's a good time to take and sell things that are high and buy things that are low. And that's what rebalancing is all about, is selling high, buying low. For instance, if we were in the opposite type of scenario and your stocks were going up, right? Rebalancing is that becomes maybe too big of a portion in your portfolio. You sell high and you buy low. Well, now you're just doing the opposite. The stocks have dropped in value, so you're going to sell those bonds that have been maintaining value, or depending on your portfolio, who knows, maybe up, maybe down, and buy the stocks while they're on sale. Again, back to store A, same things, we're going to buy while it's on sale. Okay, the last thing here just to think about, and I want to leave you on a positive as we go through what we're seeing in the headlines today, is I wanted to talk about bull markets. And you're thinking, how can this guy talk about bull markets with everything going on? I think it's important to remind ourselves that bull markets happen too. And a bull market is the condition, again, back to Investopedia here, just give you the definition. A bull market is a condition of a financial market in which prices are rising or expected to rise. The term bull market is most often used to refer to the stock market, but can be applied to anything that is traded, such as bonds, real estates, currencies, and commodities. Because prices of securities rise and fall essentially continuously during trading, the term bull market is typically reserved for extended periods in which a large portion of security prices are rising. Bull markets tend to last for months or even years. I'm going to reread that line. Bull markets tend to last for months or even years. There's no specific or universal metric used to identify a bull market. Nonetheless, perhaps the most common definition of a bull market is a situation in which stock prices rise by 20%, usually after a drop of 20%, and before a second 20% decline. So basically, a bull market's between the two bear markets. Since bull markets are difficult to predict, analysts can typically only recognize this phenomenon after it has happened. So a few more stats here in regards to bull markets. And this is back to the article from Hartford Funds. Again, just want to end on a positive note here. They've talked about there has been 27 bull markets. And if you remember when we talked about bear markets, there were 26 of those. So more bulls than bears. The average bull market has lasted 991 days, or 2.7 years. And on average, we've seen a 114% gain during bull markets. All this from an article from Hartford Funds. I'll link to it in the show notes. But as we're going through these times, in my opinion, this too shall pass. With the right strategy in place, with the right plan in place, my recommendations are to hold strong, right? First off, make sure that you've got the right strategy and plan in place, and then hold strong, as in my opinion, again, this too shall pass. But I really hope that you found this to be of value and benefit. I hope that now, as you see these different headlines, it helps you put everything into perspective. Perspective of how long this may last, perspective of what we're going through, perspective in regards to what does that actually mean to your investments and your overall value. Are your investments doing the exact same as that? Or, hey, because the market's down, maybe your investments are doing something totally different. So don't automatically assume that if the market's down 10% or 20%, that your investments are down 10% or 20%. Hopefully, again, you found this to be of value and benefit. If so, subscribe on your favorite podcast player so that way you get notified as we continue to come out with new episodes. Also, check us out on lifemoneyshow.com. Again, that's lifemoneyshow.com to see videos, podcasts, blogs, all to help you build wealth and reduce your long-term tax picture. I look forward to our next conversation to continue to help you live life today and be financially confident about your tomorrow.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.